Good evening, class, and welcome to our tax class for today. It's so nice to see all of you. I'm happy that at least 3 participants out of the 6 are here for lectures. And so right away, we will go to our topic for today so that we can start in time because we have a whole lot to cover today. Okay? Let's go straight now to what we are supposed to learn today. Okay, the topic we are going to be discussing is called capital allowances. Capital allowances. Now, capital allowances is one of the time wasters in ICANN exams. And so, before we go into the topic proper, let's look at some of the ground rules that we have established. Since week 1, people have been flaunting this rule. And most of the rules being flaunted is rule number 1. Students are muted both on audio and video. But we find out that once somebody joins in, he or she wants to on his audio, not join audio now, they want to on their audio and voices to start filtering in. That will not be good because it's going to distract the teacher, and especially the video. Once you start your video, it automatically removes the speaker's video, and it is the student's video that is going to be replaced in the recording. So please kindly don't start your audio, don't start your video, just join in and have a good lecture. Also, the use of chat buttons is important. So that any question you want to ask, as it comes into your head, don't write it in the chat button immediately. As it comes into your head, take a jotter. I believe by now you have a jotter by your side, and write down the question. The reason for that is this. In my explanation, I may answer the question and you may not even need to post the question anymore. So when you see that I have answered that question, there will be no need to ask it again. Except anywhere that is not clear, you have to ask that side of the question. Students are expected to be cordial and professional when using the chat button to ask questions. I have seen students trying to do shortcuts, and this shortcuts of today confuses me. So when you want to say, I will, don't go and put I will. It doesn't make sense to me. Let's be professional. If we are doing friendly WhatsApp and chat, is a different thing. This is a learning chat where you have to be professional. Let our professionalism be seen in the classroom. That is what we will take to the office space. So when using chat to ask questions, please ask questions that I will understand. Also, listen attentively during the lectures instead of writing, because the notes have been provided for you. Sometimes the notes may come a bit late, which we are sorry about, but nonetheless, the note is available to you. You may not have printed it, you may not have downloaded it, but in the class, the note is being projected to you, and you are going to take advantage of that provision. At the end of the class, I will leave like 15 minutes to attend to questions. So that 15 minutes time, we'll make effective use of it. So let's go straight now to our topic for today, capital allowances. Like I said, capital allowances are the time wasters in ICANN exam. If ICANN want to waste your time, they will ask you to compute capital allowances for 3 years or perhaps 4 or 5 years. That is a big time waster. But we cannot avoid it because one of the ingredients to determining the tax of a company is to compute capital allowances. Capital allowances are so important that when you get to the professional level, you will be playing a whole lot with that. So if you miss it at this foundation level, then you don't have a leg to stand. It's as if someone is creeping because this is where the marks are. Capital allowances is the basis to show that you have learned what it takes to understand taxation. So capital allowances will play a major role in your learning of taxation. So don't take this topic lightly. And so our class for capital allowances is going to be splitted into two. Today, I will be taking part 1 of the capital allowances. On Friday, I will take part 2 of capital allowance. So this week, we are going to be playing with capital allowances. In this topic, we shall see the types of capital allowances that are claimable. Those types, you'll get to find them out. You'll see the rates of computing capital allowances. So not only will you know the types of capital allowances claimable, you will know what rates for which type. You also see the methods of computing capital allowances. Then, in the later lecture, which we will take on Friday, you will see the restrictions on capital allowance computation. And then you will see what we call the carryback of capital allowances that occurs during cessation of business. So these are some of the objectives of this topic. So at the end, if you can tick all these objectives good, then your grip on capital allowances would have been very strong. Now let's get to the introduction. When a business acquires an asset, the asset will not last forever due to wear and tear. So we say that the asset has depreciated in value. Now in financial reporting, the value of an asset will reduce in the value of its historical costs due to depreciation. What I mean here is that if an asset costs 1 million naira, so you bought that asset in January 1, by December 31st, the value of that asset will not remain 1 million naira. The value would have reduced. That reduction in value of the asset is called depreciation. Now, as you would know in your financial accounting, there are many methods of computing depreciation. The most popular is the straight line method. What is the straight line method? The straight line method is cost of assets minus the residual value after the useful life will give you the depreciable value. The depreciable value divided by the number of life of the assets, that gives you depreciation for each year. That's the straight line method. It means that whatever you use in the first year, you repeat it for the second year, you repeat it for the third year. If the asset is a 10-year asset, you repeat each year the same figure, straight line. Very simple to compute. The second one is the reducing balance method. Now, this reducing balance method is your depreciation for each year is reducing. So what you charge your assets on year one will be the highest. As you go to year two, the depreciation charge for year two will reduce a bit. The depreciation charge for year three will also reduce more than year two and year one. And it is a fixed percentage. If you are given that your asset is reducing in its value on 10% on reducing balance, what it means is this. If you buy an asset for 1 million, then 10% will become 100,000. So take 100,000 from 1 million, it becomes 900,000. That is the new balance. The next year, 10% on this balance that has reduced. So 10% of 900,000 becomes 90,000. Take away 90,000 from 900,000, you get a balance. The next year, you take 10% of that reduced balance. That is what reducing balance method is. Then we have sum of digit method. Sum of digit method, if you are going to use a 10-year period, so you add 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You sum the years and use that sum of digits method to get what is going to be for the year, for the first year, second year, and third year. It sounds easy in by name, but it's a bit complicated. And so most times we don't see sum of digits either in financial accounting or in taxation, but that is a method. But there is a problem when we look at depreciation. You see, financial accountants can use different method of depreciation on similar assets in the organization. Let's take, for example, we have furniture and fittings. The way you depreciate your chairs, you may use straight line method. Then you want to depreciate your computer tables. You may say, okay, let me use reducing balance method. Other furniture in your houses, like your bulbs and all that, you may want to use any other method. So you see, there is no consistency on which method to use for the same class of assets. Not to talk about using different depreciation method for different classes. For example, you may use reducing balance method for motor vehicle. You may use straight line depreciation for building. You may use sum of digits for plant and equipment. There is no standardized method for depreciation. That is the problem. Another problem is this. The company might look at it as, okay, for the past years, we have been using straight line method. They can decide to change the next year and use another method. Now, without going back to go and do retrospective change, because depreciation is not a policy, it's an estimate. And so it is not changed retrospectively, it is changed prospectively. And so they may choose a different method the next year, And they might look at it, okay, I don't think it's really, really helped my accounting ministry. They change another method. And so you see, they change from one standard to another. Also, the lifespan of an asset may vary from one organization to another. For example, you may have a motor vehicle and you may want to charge it for 4 years. That means you've given it a lifespan of 4 years. Another person is using a lifespan of 3 years. So even if both of you are using straight line depreciation, you bought the vehicle from the same dealer, the same brand, the same day, your depreciation value will be different. This is because the lifespan of the asset, which is one of the ingredients used for depreciation, is different. So there is room for manipulation. Some organization may manipulate this depreciation just to achieve certain things. For example, if they want to achieve a loss, they can decide to increase their depreciation to increase their allowable expenses. Or if they want to achieve profit, they might decide to reduce their depreciation. So to speak, whatever the organization wants to achieve, they can do that by manipulation because there is no standard that organizes the use of depreciation. Fine, that is good for financial accountants. The tax officers, the taxation people say, no, we don't want a disorganized thing here because capital allowances are very key in determining the profit to be used. Hence, in taxation, depreciation as used by financial accountants is always a disallowable expense. So what the taxman will say is, instead of depreciation, I will give you what is called capital allowance. So instead of you telling me all these jargons that you use about depreciation, I will always give you capital allowance. Okay, that's what the taxman does. Now, take note that capital allowance and uh, depreciation are technically the same thing with different names. They do the same work. The amount written off from an asset due to wear and tear through use of the assets. So they do the same work, but let's see certain things about capital allowances that makes it different from depreciation. One, the name capital allowance is appropriate because the amount written off is treated as an allowance on the qualifying capital expenditure or the assets. So it is an allowance that you give off that capital expenditure. Note that the asset is a capital expenditure, and as such, the amounts written off on each year is appropriately called capital allowance. And so, because of it is an allowance, it's an allowable expenditure for tax purposes. So you see this clever use of words. Capital expenditure, wear and tear of it, that wear and tear is an allowance. So since it's a capital expenditure undergoing an allowance, it is called capital allowance. And since it is an allowance, we can allow it for tax purpose. So it's an allowable expenditure. Point number 2, unlike depreciation, capital allowance uses just one method for all companies. So if you are deciding to use straight line method to to do your car, which you bought in January 1, the same brand of Toyota Corolla, and you are using straight line depreciation. Another man is using reducing value. Another person is using sum of digits. You find out that you are going to be doing different method, different figures. But the taxman says, we want just one method so that we can control. So whatever you have done in your financial accounting, the taxman will say, go and add whatever depreciation you have deducted. Go and add it back and take this method I'm going to give you to calculate capital allowance, then you allow it. So you see, the capital allowance is an allowable expense. Depreciation is disallowed. So whatever you have done to deduct depreciation, you add back that depreciation and do the right thing in terms of tax. Unlike capital allowance, assets of the same class or category use the same rates or they have the same lifespan. So there is no coming to tell the tax man that, okay, I'm using 10% reducing balance here. Another person is using 20% on straight line or on costs. No, you are not telling the tax man that your lifespan, the lifespan of your asset is 20 years. Another one is saying that the same asset is 10 years. No, the tax man says we'll unify everything. All assets of the same class for everybody will be the same lifespan. So that means if you are having motor vehicle and the taxman says use this method and you must give it a 4 years lifespan, that is what everybody will do for the sake of fairness and non-manipulation. Okay, let's look at qualifying capital expenditure. You've heard me said qualifying capital expenditure. What are qualifying capital expenditure? This is a capital asset that is acquired for business purposes on which capital allowances are claimed in the basis period. So any asset you acquire for business purposes for which you can claim capital allowance is called a qualifying capital expenditure. Now, the word qualifying means not all capital expenditure of fixed assets can be classified as qualifying. Otherwise, there won't be that word qualifying. That would mean that all capital expenditure can be claimed, can give rise to capital allowances. No, they must be under what we call the qualifying capital expenditure. For example, the cost of land is not treated as qualifying capital expenditure. So you see, land is not seen as depreciable. And so land also will not be treated as qualifying capital expenditure. So if you go and buy land and you say you want to start claiming capital allowance, you are wrong. Then secondly, there are assets that you acquire for personal use. So because you heard that buildings can be claimed, you can claim capital allowance on your building. You now get a building, you develop the land, build on it, and you start living in it. You are not using it to do business. So because you're not taking rent from yourself now, it's owner occupier, you cannot claim capital allowance because that is not a qualifying capital expenditure. Take note, a qualifying capital expenditure is acquired for business purposes. These are the type that you can claim capital allowance on. Some of them include plants, machinery, and fixtures. In your financial accounting, you will call it PPE, plants, property, and fixtures. But here it is plant, machinery, fixtures. Fine. Buildings, structures of work of a permanent nature. So buildings are qualifying. The land. So sometimes you will see land and building joined together so that it will go together in your financial statement. But when you want to do your depreciation, normally it's on the building. When you want to do your capital allowances, it's on the building. Then we have mines, oil wells, and other source of mineral deposits of a wasting nature. Then we have plantations. We have research and development. You know, when they want to come out with a new brand of phone, they go into research and development. That time that they are researching that new phone, developing it, designing it, all the amounts spent into it before the phone is launched is a qualifying capital expenditure. Now we have agricultural plants. We have public transportation, motor vehicles. These include these BRT, Danfo that you see, Hayas buses. All of them are under public transportation. Your Uber and Taxify, you're using it for public transportation. Then we have public transportation, intercity mass transit coach. That under this we will see the Young Shall Grow, Chisco, ABC, the train, and all that. All these are transportation. Now, we've seen those assets that qualify to claim capital allowance, hence the name qualifying capital allowances. What are the conditions that you must fulfill before you can be granted capital allowances? Here are some of the conditions. One, the taxpayer must have incurred the qualifying capital expenditure in respect of an asset for the purpose of trade or business. I've reiterated this fact that if you are buying an asset and you are not using it for business, then you have no business claiming capital allowance. For example, the television you buy in your house is not a qualifying capital expenditure. It cannot be called furniture and fittings because it is in your house, not a business place. But if it is in your office, yes, it qualifies as your furniture and fittings. Now the point now is they must be used for the purpose of trade or business. The taxpayer must be the owner of the assets at the end of the basis period for a year of assessment. That means when you are claiming a capital allowance for the end of a basis period, that asset must not have been sold. So at the end of that basis period, the asset must have been your own property. So you can claim capital allowance on something that you own. You cannot claim capital allowance on something that doesn't belong to you anymore. So you must be the owner of the asset as at the end of the basis period. The asset must be in use for the purpose of trade or business carried on by the taxpayer at the end of the basis period for a year of assessment. Now this is linked to the point number one, that you must have bought it for the purpose of business. You know, sometimes you may buy something for the purpose of business, but later during the year, you change the use of the asset. So sometimes you may have bought something for private use, then you change the purpose of the asset. So the asset must be in use for the purpose of business for the basis period in question. Now the taxpayer must make a claim for capital allowance in writing for a year of assessment before it is granted. Now, this time around, in practice, you don't even need to write. You need to compute and show your computation to be granted. Now, there will be a certificate of acceptance for all qualifying expenditure incurred by the taxpayer in a year in excess of 500,000. All these things are part of the requirements. So the main thing here we want to take home is it must be for the purpose of business. It must be yours as at the end of the financial year or the basis period. Okay, look at some of the special provisions that are granted. Look at under hire asset purchased under hire purchase agreement. Now you see, for the purpose of capital allowances, the hirer, the one who hires the assets, is deemed to be the owner of the new assets. You know, when you want to go and buy a vehicle or a plant and machinery on hire purchase, you are not given the title. You are not given the title until you finish paying. So the title remains in the hands of the owner until you finish paying. And so if you are not the owner, it contravenes one of the conditions for capital allowance. So you start asking, should I not claim capital allowance? But here he's saying that there is what we call substance over form. Substance over form here says, you, the hirer, you are enjoying the benefits of this asset as though you are the owner. And so you are the deemed owner of the assets. So all capital allowances on the assets is claimable by you who is hiring the assets. So for example, if XYZ Limited sold its buses to ABC Transport Limited for 48 million under hire purchase agreement, and if the agreement states that ABC will pay 12 million naira each year for 4 years, then the capital allowance will be claimed by ABC on the amount it has spent so far on the assets. It means on the first year, when it's paid the 12 million, is going to claim capital. So as he keeps paying, that is a capital payment. As he keeps paying, he keeps claiming capital allowances on this amount he pays off. We are going to see it on the later question, how we are treating capital allowances when it gets to do with hire purchase. Now, this B part says the qualifying expenditure in each basis is restricted to the amount of installments paid by the hirer during the period, less any hire charge or finance charge or interest paid under the agreement. So that is what I was just explaining. So in other words, the qualifying capital expenditure in each basis period is limited to the cash price element or the capital element of the instrument or the installment paid by the hirer. Now let's look at an example here. If the buses cost during that period of time the agreement was entered, if it's cost 40 million, if that's the cost of the asset, that means if ABC Transport had paid 40 million naira cash, that is what will enter into their book, and that is what they will be charging capital allowances on. But if ABC decides to go on hire purchase and they are paying 88 million every year, that means that there will be an excess, which is called the finance charge. That excess of finance charge should be deducted. Then the remainder, you claim capital allowance. So that's what this is trying to tell us. Another special provision is asset purchased on lease. So the first one was on hire purchase. They are almost related. That is what they call operating lease, and that's what they call finance lease. An operating lease is where the lessor, that is the owner of the assets, leases his assets to another person called lessee, the hirer, under an operating lease for use wholly, exclusively, necessarily, and reasonably for business purpose. Now, the lessor, who is the owner, will be granted capital allowances based on costs. Why? Because this is just an operating lease. You are just going to hire my instrument for use for a short period of time. So whether you are the one using it, you came to hire it from me. Because you hired it from me, you are going to return it back to me. And so you don't need to charge capital allowance. It is not yours. We're just hiring it. I, the owner, will continue to charge capital allowance, even if you are using it, because there's going to be wear and tear. The asset is still in use for business purposes. Operating lease. Now, when it is a finance lease, things changes course. This is because in finance lease, ownership is going to be transferred. The risk and reward will be transferred to the hirer. So the man who is the owner is just merely a title holder. The asset will eventually go to the hiree. So this is just a financing arrangement. It's as if the hiree is tying down the money of the hirer for a long time, but eventually is going to pay and take over the asset. So that is a finance lease. Let me give you a typical example. This MTN and Lumos, they are in collaboration giving people solar generators, which you will pay for a period of 5 years. And after paying that money for a period of 5 years, the asset becomes yours. What do we call that? Finance lease. And so by day one of you taking the asset to your house, if it is for business purposes, you start charging capital allowances. Because you are not hiring it and returning it, but you are going to be the owner of the asset. The risk and reward has been transferred to you. Now that we've seen the capital allowances, we've seen the conditions to be granted, we've seen the special conditions on hire purchase and leases, let us look at types of capital allowances. Now take note, this is where I will need you to pay close attention. This part is very important. There are about 5 types of capital allowances we shall consider. We have what we call the initial allowance, we have the annual allowance, we have the investment allowance, we have the balancing allowance, and its counterpart, the balancing charge, and we have the rural investment allowances. This is where calculation have started. So I want you to take close attention to what we are going to say now. Let's go with the investment allowance. Initial allowance. Initial allowance, like the name implies, initial. It means that's the first allowance that will be granted to a taxpayer who purchases a qualifying capital expenditure. So you know that once you are calculating your capital allowance, you ask yourself, what is the first allowance I will give to the taxpayer? Initial allowance. This allowance is granted in the basis period in which the asset is first put into use. So you may buy the asset January 1 for the sake of business. It's just lying there. You have not started using it for business. But you start putting it into use in October 1, and your basis period is ending in December. How many months have you used it? Use it for October, for November, and for December. For 3 months. So you start a business, you incorporate a business in January 1, you bought a vehicle, but you've not started business. Because you've not started business, your capital allowance on the vehicle will not start counting. So it is put into use. When you start putting it into use in the business, that is when it starts counting. For example, let's see the example here. If ABC Transport Limited buys its buses and put them to use on January 1, it is going to receive full capital allowance in 2002 year of assessment, which is the basis period for January 1, 2001 to December 31st, 2001. So for the year of assessment 2002, because you buy the assets in January 1, you are going to be granted full capital allowance. That's logical. Now, what if you put the asset into first use in December, maybe December 24 or December 29 or even December 31, 2001? Now, because he put the assets into use in December 31st, 2001, that year you qualify to get a capital allowance, investment allowance on that asset, because you put the assets to use on the first day. So the point I want to make here is, irrespective of whether you put your assets into use on the first day of the basis period or on the last day of the basis period, whichever day the assets became operative into the business, you qualify for full initial allowance. Full initial allowance, no proration. Let me give you something that you may be thinking about that looks like this. When you want to register for ICANN, and the day they give you your registration number as a student, you are liable to pay subscription. It is assumed that you have been admitted into school, started attending classes, that was your admission day. That's likened to when the asset is being put into first use. Now imagine you want to write a March diet or maybe July diet, 2020 July diet exam, and you went to register for ICANN in 2019, and they gave you your exam number on 31st December 2019. This means you are liable to pay subscription for 2019 because it's assumed that you started schooling in 2019. So you pay this whole subscription, then you will pay for 2020. So the thing is, why not start in 2020 to register to save yourself 2019 fees? That's the same thing. If you put the asset into use on the last day, you charge full allowance for it. Now, note too that the initial allowance is granted just once to the taxpayer for the assets, and the asset must be his at the end of the basis period. And so, for you to qualify to gain capital allowance, two things: you must have the asset for business use. The asset must still be yours at the end of the business, and you'll be granted just once capital allowance, initial allowance, just once in the life of that asset. Let's go to the next one, which is where many people get it wrong. The annual allowance. Now, like the name implies, annual means yearly. This is the next allowance that is granted to a taxpayer in respect of the qualifying capital expenditure. As the name implies, this allowance is granted every year for a predetermined number of years. So I told you earlier that the tax authority will choose how many years that your assets must be recorded to claim capital allowance. So you cannot just say, okay, I have motor vehicle, I want to claim for 3 years or for 5 years or for 7 years. No, the tax authority will tell you how many years you can claim capital allowance for vehicle. Now, at the end of each basis period, the asset must remain the property of the taxpayer and must be in use for trading and business purposes. Now, the annual allowances are computed on a straight line basis. So you see, the taxman uses straight line basis, nothing like reduction, reducing balancing method or sum of digits. The taxman uses a straight line method. But take note, after deducting the initial allowance. So you see, if you want to calculate your annual allowance, what should come to your mind? Straight line method. What is a straight line method? Your depreciable value. What is a depreciable value? Your costs minus your initial allowance. The final figure there is your depreciable or depreciable annual allowance divided by the number of years claimable. We're going to see how we get the number of years. However, in the first year of claiming these assets, it is not fair claiming annual allowance on an asset you started using on December 31st. You claim the same annual allowance with someone who starts using his in January 1. It's just like saying, I put my money in the bank for a fixed deposit and it stayed from January 1 to December 31st. And you are giving me the same interest rate with somebody who just put his money on December 31st. It doesn't work that way. So the higher you use the assets, the higher the capital allowance you can claim, annual allowance. It's just like saying the higher you keep your money on fixed deposit, the higher interest that accrues to you. Now, in the first year, this is what happens. The amount to be charged is prorated according to the length of use of the asset in the basis period. Hence, if an asset is put into use from January 1, it will claim more annual allowance on the first year than when it was put into use in December 1 of the same year. Also, an adjustment is given to the amount charged on the last year of the predetermined number of years. What happened on the last day? On the last day, you are supposed to take everything, and normally your books will be reading 0. But the implication of your book reading 0 is you must have sold the assets. But if you have not sold the assets, it is in your asset register. When the auditors come to check your books, they see assets registered as vehicle number so and so. And in your book, it is showing 0. It's conflicting. It means the asset has left your company. It is no longer yours. So what do we need to do to show that the asset is still remaining in your coffers? Just charge the minimum amount on your assets leave it at 10 naira. You may say 10 naira is too small, but that's the reason, just to show that the asset is still in existence. So instead of having 0, have 10 naira. So when they see 10 naira, okay, this asset is still in your possession, but you are no longer claiming capital allowance. That's fine. So what happened on the last year of charging the capital allowance? Let's say you have depreciable value of 1 million naira for 4 years. That means for the first year of charging annual allowance, you charge 250,000. Second year, you charge 250,000, so 500,000 have gone. The third year, you charge 250, 750 has gone. The last year, your depreciable value will be 250. And so you will not charge 250 anymore. You will charge 250 less 10 naira. So you will charge 249,990. So that's the only adjustment, so that your book will continue to read 10 naira. So the next year, you no longer charge any capital allowance. So you see carrying the assets for 10 naira until the day you sell off the assets. That is when you can put 0. So 0 there means the asset has been sold. Now, look at some of the steps you want to take when you want to compute your annual allowance. So this annual allowance is the bone of contention of capital allowance. How you calculate your annual allowance will show if you have a grasp on capital allowance. So take note of these steps. Step number 1, note the type of assets that you are given. So you may be given motor vehicle, you may be given plant and equipment, you may be given land and building. Note the type. Then go and get the rates for the initial allowance and the annual allowance. That's important. So the first thing to do for calculating annual allowance, in fact, to calculate any allowance, capital allowance, is to get the type of the assets. Then you go and look for the initial allowance rate and the annual allowance rate. The second step is to compute the initial allowance of the asset on the first year in which the asset is being put into use. How do you do that? All you need to do is to calculate the initial allowance rate given to you, multiply it by the cost of the assets. Let's say, for example, you are given land and building, and the initial allowance rate is 15%, and you bought the land and building for 1 million naira. That means 1 million naira, you look for 15% of it, which is 150,000. That is your initial allowance. So first step to calculate annual allowance is, first of all, do your initial allowance. That's the first thing. So that would mean that you have complied by doing the initial. Now, step number 3, get the tax written down value of the asset for the first year immediately after you've done your initial allowance. So it's as good as saying, I have the assets at the end of the basis period, let me charge initial allowance. You've done step 2, initial allowance is gone. Quickly look for the balance. That balance that I usually call the depreciable value. Look at the technical name for it is the tax written down value. So this is the tax written down value that will be spread in all the lifespan of the assets. So after getting 15% off your 1 million, which is 150,000, let's see something here. Let me do something practical. Let me get my calculator. This thing has refused to bring calculator for me. Okay, hold on a moment. Let me get this calculator out. Okay, here it comes. Let's do it practical. Okay, so here comes our calculator. We have 1 million naira. 1 million naira. And we are looking for 15% of it. So 15% is 0.15, which will give me 150,000. Now that 150,000 is my initial allowance. All I will do is 1 million naira minus 150,000. That gives me 850,000. That is your depreciable value, your tax written down value. Now, the next step is step 4 says, get the predetermined number of years for each asset by dividing the annual allowance rate by 100. So you see in step number 1, you were told to go and get the rate for initial allowance and the annual allowance. Let's say we are still dealing on land and building, and you found out that the initial allowance for your land and building is 15% and your annual allowance is 10%. What does the 15% tells you? 15% tells you that's the rate you will charge your costs to get your annual allowance, to get your initial allowance in figure. The annual allowance of 10% will be used to determine the number of years the asset will last. So you don't go and say, okay, let me charge 10% on 850. You don't do that. You don't charge 10% on 850. What you do is you use that 10% to look for the number of years. So 100% divided by 10%, that gives you 10 years. Or like this example here says, if you are given 25%, you simply say 100% divided by 25% will give you 4 years. In my examples, you will be seeing me doing 100 over a particular percent. Step number 5, use the predetermined number of years that you've gotten from step 4 to get the full annual allowance that will be chargeable for the first year. Let's see what we're going to do now. Assuming we've gotten 10 years as our year of lifespan, we have 850,000. That's the depreciable amount or the tax written down value. We will now divide by 10 years, straight line depreciation. That's what we are doing. You are having 85,000 naira for every year. That is what this step is saying. Use the predetermined number of years to get the full annual allowance chargeable for the first year. So what is chargeable for the first year is 85,000, and for all the years is 85,000. But what will you do? It goes on to say, this is done by dividing the tax written down value TWDV by N. The annual allowance that will be charged if the asset is used for the whole 365 days or 12 months will be this 85,000. But we say that sometimes in the first year, the asset may not be used fully. Now, we are not calculating initial allowance, we are calculating annual allowance. So let's go to step 6. Find the length of time that the asset was used in the basis period and prorate the result you got from step 5. So let's see that this is 85,000 naira every year. Let's assume that I got the asset on March 1 and my accounting basis period ends in December 31st. So if I count from March 1 to December 31st, it is 10 months. So because I use this for 10 months out of 12 months, all I will do, I will say 85,000 times 10 divided by 12. This will give me 70,833. Or let me use a figure that will give me a whole number. Let's assume that I use it for 4 months. Let's assume I use it for 4 months. All I will say is multiply by 4 divided by 12. Okay, it's still giving me something 333. That's fine. So I've demonstrated how it will look like if it is 10 months, how it will look like if it is 4 months, if it is 11 months, if it is 6 months. Okay, let me demonstrate 6 months, because 6 months will give me something. Okay, let's go back again. 85,000 multiplied by 6 divided by 12. Good, that gives me 42.5. That means for the first year, I'm going to charge 42,500. So look at the formula here. This is the tax written down value here divided by the number of years, which was used to get the full 85,000. Now you multiply by the number of months you've used it in year 1 divided by 12 full months in the basis period. That gives you the prorated value for year 1. Now for the second year, down to the second to the last year, you will continue to use the full value that you've calculated, that 85,000 that you've calculated. You're not going to prorate it again. It's only for the first year you are prorating. So that will mean that I have 850,000 as the tax written down value. I have removed 42,500 for the first year to remain 807,500. I will keep doing this. I'll be removing 85,000 naira for year 2, year 3, year 4, year 5, up to year 9. How many years is that? 8 years. Okay, 8 years. Year 2, 3, 4, 5, 6, 7, 8, 9. So that's 8 years. So I will be removing 85,000 naira for 8 years. So 85,000 for 8 years. This will amount to 680. So I will keep removing 85,000 from year 2 to year 8 or to year 9, which is 8 years. So when I remove this 680, 500. Now this 127,500 you've gotten here is what you are using to start the last year. So you can see that it contains 85,000 for the final year, and it contains 42.5 that was not charged during the first year, that half that you didn't charge. So this is what is left in the last year. So look at what we are going to do for the last year. On the last year of the predetermined number of years, where n equals to 1, the annual allowance is computed by adjusting the books to allow for retention of 10 naira. So what you will now do for year 10, the last day of the asset, is you would not charge 85,000 anymore. 85,000, if you have to charge 85,000, you will still be having some balance here. So you see, year 1 figure, you have 42.5. Year 2 to year 9, you are having 85,000. For year 10, you are faced with 127,500. So what will you charge in year 10? All you need to do is just less 10 naira. So this is what you are going to charge, 127,490. So if you remove 127,490 from 127,500, what will be left in your books is 10 naira. So we said The reason why our last year annual allowance is higher than all the others is because year one was prorated. That other part that we did not charge to year one is now being claimed in year 10. So this is what we shall do, assuming we did not dispose of the assets. That means the asset is still ours and it is charged 10 naira in the book. It is remaining 10 naira in the book. Now, if the asset is disposed before the end of the predetermined number of years, what will happen when we get to the year in which the asset was disposed? Let's say the asset was disposed even at the end of the predetermined number of years, but before the end of the basis period. What do? All we do is we will prorate the number of time, the number of months that the asset was put into use. So let's take, for example, we have our 127,500, and on the 10th year, we decided to sell the asset after 6 months. So what we will do, we will not care about the 10 naira because the asset has gone. What we will do is, this is the figure we wanted to charge as our annual allowance. Okay, let's say we even sold it on year 9. So let me add back 85,000. So at the beginning of year 9, we are having 202,500. Now we want to dispose the assets on year 9. What do? Normally in year 9, we are supposed to charge 85,000. But because we sold the asset after using it for 6 months, we are going to say 85,000 times 6 divided by 12, and that will give me 42,500. So for year 9, we are going to sell the asset, we are going to record 42,500 as our disposal value. So when we dispose it as our annual allowance on the year of disposal. So when we do that, we will quickly calculate the tax written down value. Why do we calculate the tax written down value? Is because we want to do something called, so this is our tax written down value, 170. We want to do that because we want to know whether we will charge what is called balancing charge or balancing allowance. We'll get to it. Now, look at step number 10. Note that when an asset is disposed of, there may be computation of balancing allowance or balancing charge. Like I told you, whichever applies, we'll get to it. Investment allowance. A company qualifies for investment allowance if it incurs capital expenditure on plants and equipment. So when you say your question, plants and equipment, just rule line on it or circle it and say investment allowance. That is the only capital allowance, capital expenditure that qualifies for investment allowance. Take note, all qualifying capital expenditure qualifies for initial allowance, they qualify for annual allowance, but only plants and equipment also qualifies for investment allowance. The rate of that allowance is 10% on the cost of the asset. Now, it behaves like initial allowance in the sense that investment allowance is granted just once in the lifetime of the assets. It also has similarity with initial allowance in the sense that it is charged on the first year in which it is put into use. Another similarity is that it is never prorated, just like the initial allowance. So there are 3 things that are similar. 1, it is charged once in the lifetime, charged in the first year, never prorated. But what's this difference? Unlike initial allowance, annual allowance is not deducted to arrive at the tax written down value. Remember when we do our initial allowance, we got a figure of 150 in our example. We quickly deducted the 150 from the 1 million and we got 850. But when you are doing investment allowance, say 10%, don't deduct that value of 10% from the cost. So it's as good as saying that investment allowance is like an extra allowance given or dashed to the taxpayer that does not affect the value of his assets. So that's it. Let's look at another type of allowance. Yes, the balancing allowance and the balancing charge. Now, whenever an asset is disposed of, we usually calculate either a balancing allowance or a balancing charge. Whichever applies, we will apply it. So, what is a balancing allowance? A balancing allowance is the difference between the sales proceeds and the tax written down value. Whenever the sales proceed is less than the tax written down value. Let me explain it with illustration. In our question that we have been, in our illustration we have been doing, on year 9, we dispose of the assets after 6 months of use, and immediately we calculate the tax written down value, and we got it at 170,000 naira. Now, if we decided to sell the asset at 150, that means what you got from sales is smaller than your tax written down value. So what do? You will tell yourself that if I had not sold this thing now, maybe government was going to allow me to take 170 as part of the allowance when I finish using the asset at the end of the day. So eventually enter year 10, I will charge everything. So you see, now that you've sold it for 150, you have shortchanged yourself by 20,000. So because your sales is 150 minus your tax written down value of 170, you've shortchanged yourself of 20,000. This 20,000 becomes an allowance to you. So you apply for this 20,000 that the government is going to give to you. So because you have already collected 150 from the person who took over the assets, government is going to give you the remaining 20 as a form of a balancing allowance. Now that's it. Now let's go to balancing charge. Balancing charge is the opposite of balancing allowance. Let's assume that you sold the asset for 200,000. That will mean that you have 200,000. If you minus your 170, it means this is 30,000 excess gain. Wow. That means government will come back to you and say, wow, you are supposed to get 170. Now you have 30,000 naira extra. We are going to charge you tax on this 30,000 as if this 30,000 is part of your profit you make for business. Of course, you are selling that asset off. It is not your business trading asset. It's not the assets that you sell as your stock. This is just an asset. This asset you sold is not your stock. But government will come and say, okay, you sold the asset, made money, please tell us what you've made as profit on it. We're going to charge you tax on that. So you have made a profit on investment, we're going to charge you tax on it. That's why it is called balancing charge. The charge you get when your sales proceed from the disposal of an asset is more than your balance, your final tax written down value. earlier we said that you should always get the rates of capital allowances before you start doing anything. Now look at the rates of capital allowances here. In the exam, you would always be given, always you'll be given. Look at office equipment, look at motor vehicles. In step 1, we said get this rate. In step 2, we say use this rate for initial allowance to multiply the cost. So in the case I was telling you about was industrial buildings. I used 15% and I assume that it was 1 million and I used 15% on it. That's how I got my 150. Then look at the 10% I got as annual allowance and I said 100 divided by 10 gives me 10 years. That was how we started the journey. Note that these rates will be given to you in the exam. Look at the investment rate here. Investment allowance rate is 10%. But it's not bad if you know this rate by heart to prevent you from going to look at the book every time. But in the exam hall, one of the first things you will do in tax is to look if the rate has not changed. If it has not changed and you know them before, then rely on what you know. We also have what we call the rural investment allowance. Now, this is a relief that is granted to any company in addition to the investment allowance that have incurred capital expenditure on providing facilities such as electricity, water, card, road, telephone for the purpose of its business located in a rural area. Now, let's say Dangote decided to site a factory in a place where there is no electricity, there is no water, and there is no tarred road. And it decides to provide these amenities. That means what he spends, he's going to get 95% on it as investment, rural investment allowance. So it is from that 5% that he will be charging annual allowance. So first of all, you are doing your investment allowance, you are doing your rural investment allowance, you are doing your initial allowance, if it qualifies for initial allowance, then you are doing your annual allowance after all of this. Sometimes this rural investment allowance does not come up in computation, but it comes up in maybe theory parts where you may need to explain. Now, this is another critical place that students usually have problems when it comes to capital allowance. I've told you the first part, it is how to calculate annual allowance. The next part, which is more critical than that, is the basis period for capital allowance. Okay, so pay attention. Normally, profits are assessed to tax on preceding year basis. Refer to topic number 2 that we did last week. We said the preceding year basis is the normal basis that we charge profit to tax. Hence, if capital allowances are amounts that must be written off an asset and that will affect profit, then we also say that the asset must be yours at the end of the basis period. Then that means capital allowance must correspond with the basis period for assessable profit. So it means that if your profit is calculated on a basis period that runs from January 1 to December 31st, that means if that is how your profit is being assessed, your capital allowance will also follow suit. It's supposed to run alongside it. If, however, you decide to choose from April 1 of one year to 31st March of the other year, that is how your capital allowance will run. Now, there are certain things that we learned from last week's lecture, that we learn about the normal basis period and we learn about the abnormal basis period. When we have the normal basis period, we usually do not have problems because your capital allowance and your profit will be running on the same page. They will be on the same page. They will be having the same basis period. That's what I mean by being on the same page, the same basis period. But when we get to the abnormal basis period, and I said there are three places in which we get the abnormal basis period. I call them the three C's: the commencement rule, the change of accounting date, and the cessation rule. These are the three periods that will have the abnormal basis period: commencement of business, change of accounting date, and cessation of business. Now, when we are dealing with the abnormal basis period, then we'll have problems with capital allowances. This is because it gives rise to what we call overlap and gaps. Let's look at them. What is overlap? Overlap is a basis period where it's two basis periods that have one period common to them. So when there are one period that is common to basis period A and basis period B, there is one set of months common to them, then there is an overlap. This usually occurs when we are commencing business. Let's say, for example, you start business in January 1. So we said your first year of business will be from January 1 to December 31st of that year. Now, that means that's a fiscal year. Your second year will be from the starting of your business again. That same date that you start measuring year 1, that's the date you start measuring year 2. And you now end it in December 31st again. That means the 2 years are common to each other. There is an overlap. Another way I use to explaining overlap is this. If you are a contemporary to somebody, that means your life overlap that of that person. Let's say, for example, if anybody would say, I am a contemporary, you are a contemporary of me in exam, in ICANN, that would mean that the period I was writing ICANN exams overlap the period you also were writing ICANN exams. Let's say I finished my ICANN exams, let's say I finished 2017, assuming I finished in 2017. Anybody who wrote his ICANN exam, even for the first time, on the last day I am writing my ICANN exam, we are contemporaries in ICANN exam. Our exams overlap each other. That means when I was a student in ICANN, you were also a student. That is overlap. So let's look at the rule. When there is an overlap between 2 years of assessment, the period common to both of them is deemed to form part of the earlier year of assessment for the purpose of determining the assessment year to which initial allowances is calculated or allocated. So this overlap and gaps, mind you, is just for initial allowance. This is because initial allowance is being calculated just once. So if it is calculated once and it falls in between 2 periods, where will it fall? Where do you want to charge it to? So that's the main question that is supposed to be answered. Let's look at exercise CA1. Bukky White Nigeria Limited is a company engaged in the entertainment business. It commenced business on September 1, 2005 are made up accounts as follows. 9 months ended June 30th, 2006. What they mean here is from September 1, 2005 down to June 30, 2006 is 9 months. Then year ended June 30, 2007. It means from the day after here, which is July 1, 26 to June 30, 27 is 1 year. So you see year ended. It also purchased a motor vehicle on 1st September 2005. Remember, that is when it starts the business. So the day it starts the business, it purchased a vehicle. Required, determine the basis period for assessable profit. And look at this word here, and shows your answer will be in two forms. So you are looking for the basis period for assessable profit and a basis period for capital allowance for the first 4 years of assessment. Let's see how we do this. Let's look at the solution. First 4 years. Okay, so what do we do? Now look at the solution. It started business on 1st September 2005. So our year 1 will be 2005 year of assessment. So year of assessment is 2005. Look at basis period for profit. It starts from September 1, 2005, and it has to end in December 31st, 2005. So this is like a recap of what we did last week. Your 2006, it has to start again from the first day of commencement of business, count 12 full months. So from September 1, 2005 to August 31st, 2006. Now the third year supposed to take the make up accounts when the accounting date is ending. Supposed to take June 30th every year. But now watch. If this is the third year, which is 2017, that will mean that my preceding year basis must be 2006. Now, let's assume that this is June 30. If this is June 30, that means it must have started July 1, 2005. But the problem why it is not like this is because as at July 1, 2005, the business has not commenced. The business commenced September 1, 2005. And so we cannot achieve 12 full months based on this. So we'll repeat the second year as the third year. So can you now see that this second year and the third year is common, and there are also certain things that are common here. Now look at the fourth year. The fourth year must be normal. It must be normal. So you see, why do we say it is normal? It starts from where this one stops and it ends. Okay, it didn't start from where this one stops, sorry, because of the abnormality. It didn't start from where it stopped. It takes the 12 full months on preceding year basis. On preceding year basis. So what do we do? What we do is to look at the capital allowance basis period. So in the first year, in commencement of business, the first year of profits, assessable profit is always the same as that of capital allowance, always the same. Now, in capital allowance, you don't allow for overlap, you don't allow for gap. Look at the second year. You ask yourself, this second year that has September 1, 2005, can we find it inside here? Yes, we find it. So that means it cannot be the starting date because we can find it inside the first one, because we said whenever there is an overlap, the overlap period belongs to the earlier basis period. That means any overlap we see here must have been settled here. So we can find September 1 inside of here. What about the ending? Can we find 31st of August 2006 inside here? No. This one ends in December 25. So we cannot find 31st of December of August 2006. So since we cannot find it inside, it does not overlap. So this is the ending point for here. It corresponds to the ending point for here. So the ending point in the basis period here corresponds with the ending period for the capital allowance because there is no overlap. So you ask yourself, the beginning has an overlap with the earlier period, the end does not. So the one that does not, you bring it out. So you ask, where did the last period stop? Stop at December 1, 2005. So start counting from the next day, January 1. So you see, there is no overlap in capital allowance. So where this one stops, that is where it is continuing. So you find out that there is no January 1 here in this first period. So that's why it is taken from January 1, which cannot be seen in the first period. So that is where it takes its own. Now in the second, the third year, this is a complete overlap of that. So you see, you look at the first period here, you can find it here. You look at the last one here, you can still find it. So if you can find both of them, so there is no leg to stand, so you put dash. So there is no basis period for capital allowance. You won't charge initial allowance on the year 2007. Now you go to the last one. This is July 2006. You ask, can we find July 1, 2006 here? Yes, there is July before August, so this one does not have a leg to stand. Can we find 30th of June 2007 in the previous one? No, we can't. That's why we are bringing it down here because we cannot find it inside here. So this one has a leg to stand. So you ask yourself, since this one does not have a leg to stand, how do we start counting? You jump here that have dash and ask yourself here, where did this one stop? This one stopped at August 2006. So it starts counting from the next day, September 1, 2006. So that's how we do our normal basis for capital allowances. Now, you know that when you are doing commencement rule, you also look at right of election. You have to consider the right of election. Now, look at right of election. In right of election, the basis period for the first year is unchanged. Now, for the second year, you say you want the tax office to charge on actual year basis. So you start January 1, December 31st, January 1 again, the next year 27, December 31st. But after the third year, you must go back to preceding year basis. So the preceding year basis says that you have kept your book till June 30th, 2007. So June 30th, 2007 is here. That means it must have started July 1 to July 1 to 6. So you see, there is going to be an overlap between here and here. That's not your problem. That is the issue with commencement rule. Now, coming to capital allowance, the first year is always unchanged in capital allowances. Now, going to the second year, you ask yourself, can we find January 1, 26 inside the first period here? No, that means disqualified to stand. That will also mean that here, qualifies to stand. Because once the first has qualified, there will be no need to consider the last, because the last will always qualify. Now, after doing that, go to the next one. Can we find 1st January 2007 in this previous one? No, if you cannot, that means this qualifies. And once the first qualify, the last must qualify. Now we get to this point. Can we find January 126 here? Yes, we can find it here. Okay, July 126. Yes, we can find July 1 inside here. So the first does not qualify. Can we find June 30th, 27? Yes, we can find it inside here. So both of them does not qualify. So there is no leg to stand. Okay, let's get to the second question to see more about it. So this one will give us, we'll be working with some figures now. Example 2, James Nigeria Limited commenced as a textile business on manufacturing on 1st June 2001. So known date of commencement of business, even though it was incorporated in 15th March 2001. The incorporation date is not that important to us when we are calculating tax, although it is important for us to know when we are going to file our first tax, because it's either you file 18 months after the date of incorporation or 6 months after the end of your first year of accounting, whichever comes first. That is the only thing that this incorporation date is doing for us. Apart from that, it has no usefulness for us. Its account for the first few years of its operation shows the following adjusted profit. We have adjusted profit, as all of these are showing here. And we have qualifying capital expenditures that have been incurred. Mind you, all these are in thousands upstairs. Now you are required to determine the basis period for assessment for capital allowance for the first 5 years of assessment. That's the first part. The second part is to compute the capital allowance for 5 years of assessment in respect of the qualifying capital expenditure incurred by the company. And the third one is to compute the company income tax for the first 5 years of assessment. Now, because this is a commencement business, look at the word commenced business. Whenever you are doing commencement of business and you're asked to find for assessable profit or tax, just know that you have to do right of election. But look at what this question told you. Ignore right of election. When you see this, then that is the only time you should refrain from doing right of election. How do we solve this problem? Let's proceed. The first one, we are told to, what's the requirement there? Determine the basis period for what? Assessment of profits and for capital allowance for the first 5 years. Exactly what we did in the first one. So you will start asking yourself, when did the business start? The business starts on 1st June 2001. That's why you see me, 1st June 2001. It must end on 31st of December 2001. That's the first year. Forget about the capital allowance. Do the profit first, because it's easier to do the profit, then use the capital allowance to be checking with the profit. The second one is you have to start from the date the business started again, June 1st, 2001. You must count 12 months. So it must end in 31st May 2002. Now the third year, what you need to do is to look at when it makes its profit. You see, it normally gives us profit in March 31st. March 31st. So you come back and start doing, is it March I'm supposed to write here? Yes. Let's assume I write March 31st here. If I write March 31st, 2002 here, that means it must have started in April 2001. But when did the business start? This business started in June 2001. So we cannot achieve that. So you see me repeating the second year as the third year. So you see me repeating everything here. That's fine. Now the fourth year, you will now do your March 31st. Since it is 2004 year of assessment, the year should be preceding year basis. So it's going to be 2003, March 31st. So it must have started in April 1, 2002. That's beautiful. The next year is going to be smooth. Year ends in March 31st, 2003. Year should start in April 1, 2003, and will end March 31st, 2004. The profit side is no problem. Sweet, easy to get. That's the method to go. Once you do the profit, the basis period for capital allowance will be easier for you. So without looking at the question, all you'll be looking at is this. I told you the basis period for profits and for capital allowance for the first year is the same. So just go ahead and write the same thing. For the second year, you'll be looking at this figure here. Can we find it here? Yes, we can. So this does not qualify to go here. We'll go to the second one, the last leg. Can we find this inside of here? We cannot find it. So we qualifies to go here. So what will be here? You all look at the next date after this last one here. This is 31st December 2001. So what will be here is January 1, 2002. So that's how you determine your basis period for capital allowance. Now you come to the next one. Can we find this date here? This is an exact, if you remember, I repeated year 2 in year 3. So both here, you can find it here. Both this last period, you can find it here. So this remains dash. So let's go to the next one. Can you find 1st of April here? You see, 1st of April 2002, you can find April before May. So when you check here, try checking up again. So you can find April before May. So there's April inside here. So this does not qualify. So you now check the last one. Can we find March 31st, 2003 here? You cannot find anything 2003 up. So this qualifies. So you come here, this qualifies. So what do? You look at the next date after here, which is going to be June 1, 2002. That's going to be your capital allowance beginning date. Then when you come to this place here, where this one stops, this one starts. So you cannot find anything inside here. So once it starts going normally, once there's a normal basis period, it will be corresponding with the capital allowance. And that's it. You've done your basis period for your assessable profit, you've done for your capital allowance. It is time now to put the qualifying capital expenditure. Note here that you want to charge initial allowance only. Okay, anything you're going to put here, you're looking at not profit basis period now, it is capital allowance basis period. So any asset you buy that falls between June 1 to 31st December 2001, that is what go there. So June 1, so this one is March. So March, the business started in June, but look at March. because it started in June, this is March, it is taken as if it's on June 1. So it is taken as though it was existing in June 1. As if it's bought on June 1. So that's why you see it here. Factory and building is there. Let's look at it again. All the ones bought in 2001 will be there. Okay. Machinery is there and furniture is there. So machinery, furniture. So look at anyone bought between January 1 and 31st May 2002. So January 1 to May, this one is their delivery van, motor vehicle is here. So both of them are represented. Then anyone bought, okay, this one does not have anything, so there's nothing here. Anyone bought between June 1 to 2002 to 31st March 2003. June to 31st March 2003 is equipment. So that's it. Record it. So from here, nothing else was bought. So we were told to do for 5 years. So this is 1, 2, 3, 4, and 5. So there's nothing here. Now we are told the part B that we should look for, compute the capital allowance for 5 years. Now this is a time waster, but I will take my time to just explain 1 or 2 years for you to understand. For 5 years. So look at the thing I did here. Look at my table. I have a table for basis period, year of assessment. Now take note, basis period for capital allowance alone. Now look at the qualifying capital expenditure. You know, for the basis period we just did here, I've copied and pasted the years of assessment there, and I have copied and pasted the qualifying capital expenditure there. So year of assessment, basis period, and the qualifying capital expenditure are all copy and paste. The only thing you have to do now is, this is your initial allowance. How do you charge it? This is your annual allowance. How do you charge it? Then you total your initial to your annual allowance to get your total capital allowance. So let's see how we got our initial allowance. Workings. Initial allowance, we are given that factory building is 15%. So in the question, factory building is 3.5 million. So I simply do 15% of 3.5 million, I got 525. So that's what I did here. I got my 525. The same process I did for machinery, same process I did for furniture. I got these figures. I add them up together. I get 2,112,000. Now let's go to annual allowance. That's where the fun is. Annual allowance, I have to look at your costs. This is for factory building is 3.5 million the cost, minus your initial allowance. I'll get a figure divided by the lifespan. And I told you that the lifespan is gotten from annual allowance. We have 100 divided by 10%, which is 10 years. That is what it means, 10 years. So all I will simply do is 3.5 million minus 525,000, which is the annual allowance. Anything I get, I divide by 10 years. That means this is my annual allowance for every year. But now, this is for the first year alone. This is for all the years. So for the first year alone, what do I need to do? I'll need to check when it was bought. When it was bought. Sorry. I'll need to check when it was bought. It was bought when? Factory building March 2001. So I'll start counting from March 2001, 10 months out of 12. So all I need to do, I'll take this figure, multiply it by 10 all over 12. So this is the amount I'm going to charge for the first year alone. That's the same process I did for all others that were charged. I did their full depreciable value, their full capital allowances, and now prorate for the first year. So if you look at the solution here, these annual allowance are the prorated figures. And look at the total of the prorated figures. So when I add this figure to this figure, I get this figure here. That's my total capital allowance for the first year. Now, going to the second year, I did the initial allowance the same way because that was when we got our van. I did our initial allowance here for van the same way, and I got 250, which I put in the initial allowance figure. Then what do I do for the annual allowance for motor van in the year 2002? Now, your annual allowance will be your initial allowance minus your cost minus your initial allowance divided by the lifespan. This is 4 years, and I get 62,500. And now prorate this 62,500 for the number of period it has been. It was purchased when? It was purchased, look at the year and the month it was purchased. Delivery van February 2002. So I asked myself, February 2002, look at the basis period. This is January 2002 to May 2002 is 5 months. So that will mean that I'm prorating for how many months? For 2 months out of 5. So I got 25,000. After getting 25,000, I do the same for all others. So this figure here for the second year is the prorated figure here, the prorated figure for motor vehicle, for motor car, doing the same method. But what about this 760? How did I get this 760,000? All I did was simply go to your annual allowance for 2002. After I have done all that, I will not charge those assets I bought for 2001. In the first year, I have prorated and used this. In the second year, I'm going to use these figures, and these figures. So in 2002, we are in their second year. So you see me using their full value, and I got 760. So that's the 760 I got here. That's the 760 I got here. So what I did again was to add this to this to this to get this 760, and I added it to 850 I got from here to get my total figure here. In our next class, we are going to revisit this question again, because I know that for some of us, it may be as if we are speaking in tongues. So when we revisit this question, we are going to do the assignment later. I'm going to give you the second one as an assignment because I have an assignment here for you. So for now, you may not want to do it. So let's see if I have any question from the class. Wow, the class is so lively. There is no question for me. And unfortunately, I have run out of time. Any question, feel free to send it to me to the WhatsApp group or to chat me privately. Mind you, we are going to take example 2 again in our next class on Friday. And probably we'll finish the whole of capital allowance. So today has been much more of talking and few of exercises. So come prepared next week. when we are, I'm sorry, next class when we shall take in-depth calculation. Thank you so much for making a memorable class today. See you on Friday.
Hello, Prof.
Why do I put it